This is a demonstration of problem 841B using ratio data to evaluate a company's financial position. The comparative financial statements of Newton Cosmetic Supply for 2018, 2017, and 2016 include the data shown here, and the problem gives us partial balance sheet information and partial income statement information for 2018, 17, and 16. The requirements state that we need to compute ratios for Newton Cosmetic Supply for 2018 and 2017 first. So the first ratio that we are going to compute is going to be the acid test ratio. Our acid test ratio includes our cash, short-term investments, and accounts receivable in the numerator. So we're going to copy that information from the chart that was provided to us and calculate the numerator for the acid test ratio first. These are also called quick assets. They don't include merchandise inventory or prepaid expenses. So now we get a total of the quick assets for the company for 2018, $540,000 and $480,000 for 2017. The denominator of this ratio is total current liabilities. So we're going to copy that information from the chart above. $530,000 for 2018 and $630,000 for 2017. Then I have my spreadsheet set up to calculate the ratio. The numerator, which was the total of the quick assets, divided by the current liabilities, and we get the acid test ratio for 2018 is 1.02, and for 2017 is 0.76. So what does this ratio mean? It means that, for instance, in 2018, we have $1.02 in quick assets for every $1 that we have in current liabilities, and in 2017, we have 76 cents in quick assets for every $1 that we have in current liabilities. The next ratio that we are going to compute is the accounts receivable turnover ratio. So in order to compute this ratio, we need our average accounts receivable for 2018 and 2017. So I'm going to put into my spreadsheet the accounts receivable net for all 3 years so that it will calculate for us our average accounts receivable for 17 and 18. So what this has done is it has taken these two numbers for 2018, added those together and divided by 2. And the same thing for 2017. It has added 260,000 and 220,000 and divided by 2, and we get 240,000. The next information that we need for accounts receivable turnover is net sales, and the problem has provided us with the net sales for both of these years. So we're going to put that information in the spreadsheet, and it now is going to calculate the accounts receivable turnover. So the accounts receivable turnover is net sales divided by average accounts receivable. So in this case, $5,850,000 divided by $285,000 is 20.53, and $5,110,000 divided by 240,000 is 21.29. So what does this ratio mean? It just tells us how many times our average accounts receivable has turned over during the year, because we know that this can also be net credit sales is our total, and then when we get that average we can tell how many times it has turned over within the year. And the next ratio that we're going to compute is called the days sales in receivables, and it uses the accounts receivable turnover. It's 365 divided by the accounts receivable turnover. So we take 365 and we divide that by our accounts receivable turnover, and we get 18 days for 2018, and we do the same thing for 2017, and we get 17 days for 2017. So what does this ratio mean? It means that on average we have collected our accounts receivable balance in 18 days in 2018 and in 17 days in 2017. Now, the second part of the problem is asking us to consider each of the ratios individually and decide which ratios improved from 2017 to 2018 and which ones deteriorated, and is that trend favorable or unfavorable to the company. So we notice that our acid test ratio increased from 2017 to 2018. Now, is this favorable or unfavorable? This is actually favorable. We want this ratio to be as high as possible because it's more coverage of our current liabilities. The more quick assets we have, the more likely it is that we'll be able to pay our current liabilities on time. So that one increased and it was favorable. Now let's look at the accounts receivable turnover ratio. It went from 21.29 in 17 to 20.53 in 2018. So that ratio decreased. Now, is this favorable or unfavorable? This is actually going to be unfavorable, and the reason why is we want our average accounts receivable to turn over as quickly as possible because that means that we're collecting the money quicker. If we can collect the money quicker, we can then invest in more inventory and make more money. So that is a decrease in a ratio that's unfavorable. Now let's look at our days sales and receivable. We went from 17 days in 2017 to 18 days in 2018. So this ratio has increased. Now, is an increase in this ratio favorable or unfavorable? Well, again, it's going to be unfavorable, and for the same reason that the accounts receivable turnover was unfavorable. The quicker that we can collect that accounts receivable, the quicker we are able to invest that money in new inventory and make more sales. So we actually want to see that ratio be as low as possible. So that is the end of the demonstration for problem 841B.